Hey, how's it going, guys? Have you wondered how exactly those hedge fund managers build their fancy portfolios and generate crazy returns? What if I tell you you can also build a sophisticated, profitable portfolio just like a hedge fund manager on your own? In this video, I will show you step by step how exactly you can do it. Please make sure you watch the video until the end and don't miss out anything. I promise you I'll make it quick and don't waste your time. Alright, let's get started. Before we start building a high-level hedge fund portfolio, it is necessary to have an overview on what are the common strategies the hedge funds were using to make money in the past 10 years. There are thousands of different hedge funds in the world with their own unique approaches to the market, but they basically fall into one of these four major categories. Number one is called a market neutral. This type of hedge funds usually use a long-short pair trades to take advantage of those short-term mispriced arbitrage between two financial assets. I'll give you guys one very simple example. You pick two highly correlated stocks. Normally they're in the same industry. You long the underpriced one, and at the same time you short the overpriced one. You take profits when these two stocks reverse to the mean. There are tons of other arbitrage variations to build a market neutral strategy around. Okay, the second major category is the deep value activist hedge funds, which are led by those superstar hedge fund managers like Bill Ackman and Carl Icahn. By the way, these teams don't really like each other.
Ackman is a liar, okay?
These hedge fund managers normally look for companies with fundamental problems and relatively cheap stock prices. Then they will aggressively buy a lot of shares of those companies until they become the major shareholder. Once they become the major shareholder, they will rebuild the business model, change the management teams, reshuffle the board members. Basically, they will do anything it takes to bring the business back, boost the share price, and make huge profits. Of course, they often do the opposite too. They look for those companies with controversial business models and overvalued prices. Then they will short the stocks, and at the same time, they will do whatever they can to destroy the company, drag the share price down so that they can cash out with the big profits from their short positions. Alright, the third category is the quantitative hedge funds. This type of hedge funds are normally run by the genius mathematicians and the Nobel Prize economists. They leverage quantitative analysis and the technology to crunch a huge amount of financial data and automatically make trade decisions based on the super complex mathematical models or machine learning techniques. Also, high-frequency trading belongs to this category too. Then the last category is called the full cycle global macro. These global macro hedge funds analyze how the macroeconomic trends affect the equity price, interest rates, currencies, commodity price, and monetary policies around the world across the full economic cycles. Then they will take long or short positions in those asset classes are most sensitive to their macro views in different stages of the cycle. This is the most common and also the most suitable category for retail investors to study and follow. If you can do it well and know how to build a full cycle investing portfolio, it can be extremely profitable. And this is exactly the type of portfolio we're going to build today. Also, another very important reason I want to make this video is that the traditional 60-40 passive investing portfolio is already dead. In the next 10 years, from 2020 to 2030, passive investing will slowly transform back to active investing again. And the ones who can truly make money in the next 10 years are the ones that know how to take advantage of different economic cycles and position their portfolio accordingly. Alright, now let's move on and I will show you guys step by step how you can build a full cycle investing portfolio like a pro. Just a quick disclaimer here. The main financial model I'll be using in this video was originally designed by former hedge fund manager Keith McCullough. Building a modern hedge fund portfolio can be extremely complex, but I find that Keith McCullough's model is the easiest to be understood and adopted by the retail investors. I'm not sponsored by him or any party to make this video, and I do not achieve any financial gains by sharing it. This video is purely for educational purposes. The very first step to build a full cycle investing portfolio is to understand and apply the concept of the rate of change. This is huge, guys, especially if you are new to the financial market. So what is the rate of change? The rate of change is the speed that shows how fast a certain variable changes over a specific period of time. Or simply put, the rate of change represents the momentum of any given variable. Why is it so important? Because understanding and applying the rate of change in the financial market can help you buy and sell ahead of the majority of the crowds. And this is exactly one of the secrets that separate the experienced professional investors and the beginners. Let me give you a quick example to help you understand the rate of change better. Let's say there's a country called XYZ. In 2019, the first quarter GDP growth was reported 1% by the government. The second quarter was 2%, and the third quarter GDP growth was 3%. So based on the numbers, it looks like a healthy, stable growth. But if we apply the rate of change, from the Q1 to Q2, the GDP grows 100% faster from 1% to 2%. That is a very impressive result. However, from Q2 to Q3, even though the reported number increased another 1%, the rate of change actually cuts half to 50%. That is a significant decline over the GDP growth momentum. And if you are investing in this country XYZ, you should start already pricing in this growth decline where everyone else is still cheering the GDP number looks good. And this is exactly how the smart money institutional investors navigate the financial market. They never get fooled by the CNBC talking heads shouting at you, the Dow went up 300 points yesterday. They don't care. What they truly care is the movement, it's the rate of change behind those numbers. Alright, once we understand this, we can move on to the second step, which is dividing the full economic cycle into 4 different quadrants. How to do it? We closely track the data of 2 biggest economic indexes, GDP growth and inflation, on quarterly basis. Then we calculate their rate of change between each quarter. When the rate of change goes up, it means accelerating. When the rate of change goes down, it means decelerating. So if we do that, we will have these 4 extremely important economic outcomes. Each one of these economic outcomes that based on GDP and inflation data will represent each unique economic quadrant. For example, the quad number 1 is called reflation. When GDP accelerating, inflation slowing down. Quad 2 is called inflation. When both GDP and inflation accelerating. Quad 3 is called stagflation. When GDP growth slowing down, but the inflation accelerates. Quad 4 is called deflation. When both GDP and the inflation slowing down. So basically, the entire economy goes in cycles and constantly keeps moving between each quad. This model helps us to visualize which part of the economic cycles that we came from and where we're potentially heading into, so that we can position our portfolio before the big market swing comes. Alright, once we get our economic quadrants right, then we can move on to the step 3 and design the best asset allocation according to each quad. In reality, there are hundreds of different financial asset classes that a hedge fund can trade every day. In this video, I will simplify the process for you guys and show you the most basic asset classes, including all their respective ETFs, so that you can easily buy and sell on your own. First, US equity market. I put them into 2 major categories, large caps and small caps. Second, US bond market. I will list down the 3 most common ones, long-term treasuries, short-term treasuries, and high-yield corporate bonds. Then we will have currency market. Here I will list down the US dollar and the emerging market currency. Finally, we'll have the commodity market. I will mainly talk about the gold and the crude oil. Alright, now let's take a look at how all these asset classes usually perform in each economic quadrant based on the historical data. In quad 1, the reflation quad, the equity market in general will perform pretty well. Large caps will slightly outperform the small caps. Bond market usually struggles in quad 1, especially the government treasuries. So you usually see many hedge fund managers reduce their treasury positions and transfer those funds to high-yield corporate bonds in the quad 1. In the currency market, usually we'll have a transition from dollar strength to the emerging market currency. Commodity-wise, oil will usually struggle, and the gold price will usually top in the quad 1. In the quad 2, the inflation quadrant, this is the high growth period in the economy. So this is the time you should position yourself into more risky assets. Equity market and the corporate bonds are usually the rock stars in the quad 2, and this is where your money should be. Quad 2 is the time you should sell most of your treasuries, especially long-term treasury positions, and put them into the equity market. US dollar will suffer a lot in Quad 2. Emerging market currency will usually rally against the dollar. Oil will perform very well in Quad 2. Gold should be purely used as a portfolio hedge, and you should not overweight on gold positions during the Quad 2. In the Quad 3, the stagflation period, in my own experience, is the most difficult time to trade. Stock market will usually top in quad 3. Big caps will outperform a lot more than the small caps, and most of the times, the small caps will enter a downtrend in quad 3. Bond market will do well in quad 3, especially long-term treasuries. The main reason is that more and more institutional investors are forecasting the growth is slowing down and there will be more and more risk in the market. Then they will take profits from the stocks and the high-yield corporate bonds and put them back into safe assets like treasuries. The biggest signature market move in Quad 3 is the oil rally. Crude oil will usually rally really fast during the stagflation Quad 3. And then lastly, the Quad 4, the deflation Quad. Risky assets like stocks and corporate bonds will struggle a lot in Quad 4. Sometimes there will be even a big crash in these two markets like we just saw in March this year. So obviously, at the beginning of the Quad 4, you should stay away from equity and the high yield markets, or at least you should significantly reduce your exposure to these two markets. The bond market is where your money should be in the Quad 4. Dollar will be very strong as demand for cash goes up. Emerging market currency will crash as they usually do a lot of money printing and buy US dollar when the economy suffers. Gold is a rock star in Quad 4, and the crude oil is usually the biggest loser. Alright, so this entire chart shows how these asset classes usually perform in each economic quadrant. After understanding all this, then we can go to our final step and build our asset allocation in each quad. In the quad number 1, the average global macro asset allocation looks like this: 40% equity, 10% high yield corporate bonds, 35% treasuries, 10% emerging market currency, and 5% gold. In the quad number 2, it'll be 50% equity, 20% high yield corporate bonds, 20% treasuries, 5% crude oil, and 5% gold. In the quad number 3, 35% equity, 5% high yield, 35% treasuries, 15% crude oil, and 10% gold. And finally, in the quad number 4, we'll have 15% equity, no positions on the high yield corporate bonds, 55% treasuries, 15% US dollar, and 15% gold. Alright, there you have it, the asset allocation for each quad to produce the best return. Of course, in the real hedge fund world, it is way much more complex than this because the portfolio managers usually deal with hundreds of different asset classes across all over the world to construct their full cycle investing portfolio. The one I'm showing you guys right now is the oversimplified version to help you guys understand how the full cycle investing works. And most importantly, I wish to inspire you guys that apart from the old school 60-40 passive investing, there are many other ways of investing you can explore to generate better returns on your own, especially when the market regime shifts dramatically like what we're going through right now in 2020. Alright, that will be the end of this video. If you're new to this channel, my name is Vic. I make videos every week to share some of my thoughts on what is going on in the financial market and also share some educational contents to help your investing journey just like this one. If you are interested in the world of finance and the business and find my videos have been valuable to you, please consider subscribing. Thanks so much for watching guys, and I'll see you guys soon.